Hey guys, this is the Trading for Dummies series brought to you by Mastermind Trading. Introduction. In previous video, we basically looked at how the financial market basically started with the government and soon it got taken over by the private traders and private market participants. In this video, we want to look at two kinds of traders that they are in the global financial market and how they differ from each other. First, there's retail trading, which basically is trading activities done by individual traders like myself, yourself, and probably any other trader that you know. And then there is institutional trading, which is the trading of financial assets that is done by large institutions basically. There is quite the difference between retail and institutional trading, but these four stand out to me. Retail traders basically invest their own money, they invest relatively smaller capital, they trade less frequently, and are non-professional investors with limited capital. While institutional traders or investors invest on behalf of individual investors, invest and trade relatively larger capital, trade more frequently, and are specialists with access to exclusive resources and information. Some institutional market participants include banks, hedge funds, investment banks, mutual funds, pension funds, insurance companies, sovereign wealth funds, proprietary trading firms, and the list goes on. One thing to have in mind is the global financial market, just like every other market, for there to be trading activities involves two basic participants, the buyers and the sellers, the ask and the bid. And similarly, after every trading activities, there is the winners and the losers, the profit and the loss. Which means that for one to buy, another have to sell, and just as much, if one is winning, another have to be holding a losing position on the other end of the trade. Because trading is a game of numbers, and in this case, a game of money, capital, and banks and institutional traders basically make up roughly 70% of the market. It means that to a very large extent, they influences market movement. They influence to what direction the market move, and it is in an attempt to catch this big institutional move. Retail traders have learned to read the market like institutional traders, to trade like institutional traders, to observe the market like institutional traders. Some signs of increased institutional activities in the market include increase in volume, like sudden increase in volume, option flows, dark pool prints, unusual order flows, order book clues, and a lot of other candlestick and price action method for identifying institutional activities in the market. Now, my advice is simple. Trade with institutions, not against institutions, in a game of numbers, and in this case, in a game of money. Who owns the larger amount wins. Follow institutional footprints, not fight against it. I remain Monaco Daniel from the world most populous Black nation. See you guys in the next video.